Okay, good morning and welcome back, everyone, to our Monday morning trade ideas research session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are starting off another week on the back of more higher highs on the S&P 500 and the Nasdaq 100. Both notched new records last week, and we also have the VIX closing below 15% for the first time in nearly 6 months. And we are now in the bottom decile in terms of implied volatility for the S&P 500 over the past year. So we're entering a environment that, generally speaking, is favorable to be buying volatility, being long volatility, such as buying tail hedges on the S&P 500. We do have a big week coming up. We have a lot of things, obviously a big week in terms of earnings, the biggest week of the earnings season. You have the FOMC meeting this week, which we expect the interest rates to be held steady. You have a jobs report at the end of the week. You have the Fed's preferred inflation gauge, the PCE inflation, coming out this week. And you have GDP. So a big week across the board on economics, on corporate earnings, and also you have the August 1st trade deadline, which at this point, with the EU and Japan having reached an agreement, Canada and Mexico are the two that are still out there, but I don't particularly think that those two are necessarily going to move the market substantially. So I actually think that, we're entering a, environment that, generally speaking, is not particularly going to be conducive um, for a pickup in volatility, such as the April tariff deadline, and arguably a lot of the things that we have been concerned about here over the last few months. Some of that stuff has already started to turn a bit, towards the positive side, and that's largely around consumer sentiment, consumer spending. So I'm not a big fan of buying protection just because it's cheap. I usually want to buy protection because there's a real reason to be buying protection, and the reasons to need protection at this stage are just fewer. But that doesn't take away from the fact that the equity markets are, by most means, both technically and fundamentally stretched. You have, the S&P that's up over 30% in the last 3 months. We have reached, by all accounts, overbought conditions. I'll even show you the overbought, or rather the counter trend sell signal that generated on the S&P 500 just on Friday. Which is one particular reason that you might want to consider buying some downside protection. Just technically, we've gotten to a point that's so stretched, historically speaking, we're due for a bit of a pullback here. But even on a fundamental perspective, you have the S&P trading at 22 around 22 and a half times forward earnings, which it's just historically incredibly high from a valuation perspective. But there's still at the same time a lot of positives to look forward to. You have potentially an interest rate cut next month that the market is pricing in. You have consumer sentiment and consumer spending that has remained incredibly resilient despite kind of the uncertainty, and potentially even accelerating a little bit towards the second half of this year. And you have AI that just continues to, the demand for it seems to be quite insatiable. And, at this stage, all of the major tech companies are investing tens of billions of dollars per year to be leaders. And there's just a lot of money flowing through these types of companies. So, in the short run, in the long run, there could be ramifications with that and what that entails. But in the short run, things look quite positive and things look like that the demand is there. So for all of those reasons, I still think that for those of you that are concerned about, buying some downside hedges might make sense. But, the reasons to need those downside hedges at the moment seem relatively scarce. So looking at our ideas here for today, We have quite a few that we'll be going over. But before we jump into it, we're going to look at kind of from a macro perspective, right? So this move here, this is sort of unprecedented in terms of the speed and magnitude of this move that we've seen here over the last 3 months. Not to mention, this move that we've seen has been largely unchecked with any pullbacks or any consolidation. It's just been a straight march higher, and it's been a continuous grind higher here in the last month and a half or so. So, we have reached kind of this counter trend sell signal here. We also have a little bit of negative divergence here as well. Higher highs in price no longer being confirmed by higher highs in momentum, and reaching a level that's so extreme that historically speaking, we've seen pullbacks here, especially on the S&P 500. This is a sell signal that has, about a 70% accuracy in the long run. So, those are some of the things that you have to respect from a statistical perspective. But like I said, 30% of the time, markets don't pull back, when these signals are generated. So it's not foolproof. So keep in mind some of those things. The NASDAQ, no different, basically the exact same chart setup here. Unprecedented move in terms of both speed and magnitude. As you can see, we haven't generated that sell signal here on the Qs just yet, but you have the same negative divergence here, higher highs in price, no longer being confirmed by higher highs in momentum. These are some signs that markets are getting exhausted here to the upside, which is not surprising to see that, after such a big move. You have the Russell 2000 that has managed to break out above that 210 level here. It hasn't moved as much as the NASDAQ and the S&P 500, and the equal weight S&P 500, after stalling a little bit here in the last couple of weeks, started to continue to rise here again. So we're starting to see participation continue um, to improve, but it's not particularly strong here on the S&P 500, considering we've been making higher highs for the past 3-4 weeks, on the S&P 500. If you look at high yield corporate bonds, we continue to make higher highs as well, which is a good sign. We're seeing that the credit market is not concerned about, consumer spending, and even though there are some signs also here in terms of exhaustion here, higher highs in price no longer being confirmed by higher highs in momentum. But from my perspective, that is likely to lead to a little bit of consolidation rather than a big pullback here. And bonds, stabilized here over the last few weeks, showing us that yields haven't moved much higher here, but it's still something that we should be aware of, that, both 10 and 30-year yields are remaining near, 52-week highs rather than 52-week lows. And that really speaks to the fact that inflation is still one of those things that is, on the back of everyone's mind, certainly on the back of the Fed's mind, with regards to whether or not the tariffs will have to, result in some level of inflation, and that's going to require kind of keeping interest rates where they are, or we're going to start to see that the kind of tariff-induced inflation has not reached the predicted levels, and that we can start lowering interest rates, which is at the moment what the market is sort of pricing in, is a couple of more rate cuts here before the end of the year. So that's where we currently stand from a macro perspective. So now let's look at kind of where we sit from a trade ideas perspective. So we've added one more trade here last week on CrowdStrike. So we'll take a look at that, and we'll take a look at our outstanding positions. So one of the positions that we added last week, which was Merck's, this is a stock that recently broke out here above the $78 level here. It broke out, retested this level of support. It's kind of just on the verge of breaking out from this $85 level, which was kind of the next level of support and resistance. We'd like to see this kind of breakout here to confirm this bottoming formation. We haven't quite broken out there. We've broken out above that first level here. We really like to see that breakout above 85, and that would target us to the $90 target here to the upside. So we're making our way there. As you can see, Merck's trades at a discount relative to the industry, yet it's expected to grow faster than the industry and it's more profitable than its industry. So, for those reasons, the fact that it trades at such a heavy discount relative to its peers is really what makes this attractive from a fundamental perspective. And then you look at the technicals, that really shows us that investors are also starting to pay attention to, and we're seeing a little bit of accumulation and outperformance of the stock in the last few weeks. That might make the timing on this optimal to be adding some bullish exposure here um, to Merck's. Pinterest. This is another one that we've liked for a while. But as you can see, recently it broke out here above this $35 level here. This is one of the stocks that we like. We have earnings coming up in about 10 days, and I think that could be a potential catalyst to move this stock substantially higher here. As you can see, it trades at basically in line with the industry. But if you can see, expected growth rates are substantially higher than the industry. Net margins, this is a bit of a deceptive number here. And net margins are not actually 50%. It just shows 50% because they had some tax credits that a couple of quarters ago, and it's still being cycled through the trailing 12-month numbers. That right now they're basically at break even on their business. So this is really one of the areas that Pinterest is working on is profitability, and we're looking at that as a potential reason for Pinterest to turn their business around, being more profitable. So if they can be a business that generates net margins in the 6-7%, then we have the ability to potentially trade at a much higher multiple than where it's at right now. I think that the valuation at the moment is relatively fair, but the technicals are showing us some level of accumulation by investors. And I think that's really what makes this opportunity interesting. That is kind of early on before perhaps everyone else catches on. Block. This is one that we have liked quite a bit here. But basically on this breakout here above 67.5. We caught this breakout here early. This has been a nice move here, especially recently we've had this nice move here to the upside. And our initial upside target was 85. So we're getting close to that initial 85 upside target. Notice that it did generate a counter trend sell signal here. Now, here's the thing is that we didn't generate any negative divergence. So I generally don't take these counter trend sell signals, particularly if we don't get divergence alongside with it. So, and keep in mind that this is a stock that we've been long here since in the 60s. So the fact that it's ran all the way up to 80 in a short period of time, it's not uncommon to see these kind of pull back here, provide a little bit of consolidation before they continue on. So that's kind of par for the course. We've had a really nice move here. Just getting a counter trend sell signal is not a bad sign. That means it's got a nice move here to the upside. We might see a little bit of consolidation ahead, and then looking for that continuation higher here, especially earnings coming up in 10 days. That could be the potential catalyst that actually drives this higher. And if you look at the business, Block trades at a substantial discount to its industry, even though it's expected to grow faster than its industry, and it's more profitable than its industry. So the fact that it trades at such a heavy discount is really what provides such a compelling opportunity right now for this particular stock. And the chart clearly shows, that bottoming formation to be complete. And now we're seeing the stock outperform after it completes that bottoming formation, which is a really good sign. And this is a chart setup that we really like to see, especially for undervalued stocks. Alphabet, they reported earnings last week, quite strong earnings. The stock reacted initially quite strong, pulled back a little bit here, still trading at 193. Our upside target initially was 185 when we first caught this stock here back here in mid-June. We bought the stock on that pullback here. The stock rallied substantially here since we've entered that particular position. Our initial upside target, like I said, was 185. So we've met that objective. And after earnings came out positively, our next upside target here is 202, which would fill this gap here to the upside. So we're getting there. We're getting very close now to our second target of 202, or about $9 away from that upside target here. And even still, we're still trading at a discount relative to the industry, even though we've had a really nice rally here in the last month or so. If you look at growth expectations, we're basically in line with the industry, but where Alphabet really excels is are its net margins. And the earnings report last week really showed us that some of the fears that people had with Alphabet being disrupted with AI, that we were all going to use ChatGPT instead of Googling things, clearly that concern has been to some degree alleviated in terms of the amount of growth Alphabet has had themselves on their AI with their Gemini Pro, as well as their integration of Gemini into Google search has been incredibly positively received. That kind of counteracts a lot of the concerns that people had with regards to whether or not ChatGPT and some of the other large language models were largely going to basically replace Google search. So I think for those reasons, investors are kind of removing some of those fears, and then kind of reinvesting in this particular stock. And by far, out of the Mag 7 stocks, Alphabet trades at the cheapest valuation, at the lowest valuation of any of the Mag 7 stocks. And if you're looking for exposure to AI, this is by far one of the most cheapest ways to go about doing so. Outside of NVIDIA, Oracle, Meta, Microsoft, all of these kind of big AI related plays, they're trading north of 30 times forward earnings. So Alphabet is trading at a valuation that's 33% lower than that. So I think for those of you that like AI, Alphabet is definitely going to be one that you want to have in your portfolio right now. The next one here is Target. And we've really seen a bit of a turnaround here in terms of retail. And Target, after having completed this $100 bottoming formation here, broke out from 100, and that's when we added this position here. It's consolidated a little bit here over the last couple of weeks, but started to break out here above 105 here last week. We're looking for this to continue on to our $130 upside target. Last week it looked a little bit precarious where it could potentially get back below 100. And I said if it got below 100, we would consider removing this bullish thesis. But so far, we've kind of continued to make higher highs and higher lows. So we'll continue to maintain our bullish view here into that 130 level here. And as you can see, Target continues to trade at a discount relative to the industry. Growth expectations in line with the industry. The only thing that Target's really struggled with is revenue growth. And we'll see how they execute on their e-commerce business and their digital business, because net margins are really what I think is interesting about Target. Their net margins are higher than 75% of their peers. So they're an incredibly efficient company. They're the only one of their peers that pays over 4% dividend yield. So I think for a lot of investors, this is a stock that is overlooked when you think about Walmart and Costco and some of those names trading at 40 to 50 times forward earnings. Target, very similar business, and in certain ways a better business, trading at only 14 times forward earnings. I think very much worth looking at adding to your portfolio. Looking at Schwab. This is another one that recently reached our upside target here. So we've kind of updated our upside targets to 108. As you can see, Schwab trades at 22 times forward earnings, which is a discount to the industry. But if you look at growth expectations, it exceeds its industry by a pretty significant margin. And more importantly, net margins they've actually improved their net. They've actually expanded net margins in their latest earnings. Now that they're earning 33%, so 33 cents on every dollar they generate in revenue, they turn into a net profit. So the fact that it trades at 22 times forward earnings is really what leads me to believe that at the very least, this company deserves to trade at 25 times forward earnings. But in reality, it should be trading at a higher multiple because it grows faster and it's more profitable. So our 108 upside target is really reflective of what if this stock is basically just trading back at 25 times forward earnings. That's what we've put our upside target here is. But I actually believe that if we can hit 108, there's even further upside above that. And as you can see, this stock has made a new 52-week high here for quite a while now, right? It's made a new 52-week high back in May, and then it continued to make new 52-week highs in June, making new 52-week highs in July. This continues to outperform its sector and the market. And it continues to accelerate here to the upside. So we maintain our bullish view here in Schwab. And lastly, Micron. This is a stock that we added back here in the $90 level, and it broke out here above this kind of breakout level here above 90. The stock has rallied substantially into that 130 level prior into earnings. The stock has pulled back now into that 110 level here. And that's really where I think for any investors that may have either missed out on that first run, or if you're looking for new bullish opportunities, I think Micron is an interesting one to potentially look at, because this is one that continues to look fairly undervalued relative to their peers. Micron's trading at 9 times forward earnings. And when you look at growth expectations, we're looking at numbers that, rival kind of what NVIDIA look like in terms of growth numbers. The reason for that is because they're one of the main chip suppliers for the memory chips that go into NVIDIA GPU chips. So if you're looking for a way to invest in kind of the hardware side of the AI business, there are very obvious ways through companies like NVIDIA. But when NVIDIA is trading at nearly 40 times forward earnings, it's just an expensive stock to continue to buy at these levels. The AI market needs to grow at a pretty substantial pace in order for those valuations to be maintained, versus Micron trading at 9 times forward earnings has a lot less downside risk and a lot more upside potential here. So that's why I really like Micron, especially since the stock has had a really nice run, has pulled back about 50% of that move here, and I think has the potential to continue moving on. Our upside target is 135, which I think is still a relatively low target if you look at kind of where it's trading at from a multiple perspective. And then now if we look at kind of our bearish opportunities, the new one that we added to it was CrowdStrike. And we added it because, as you can see, this stock has been on a significant uptrend here, but in the last few weeks, as the S&P 500 has made new highs, CrowdStrike has actually continued to turn lower here. And look at the trend quality; it's deteriorated quite a bit here in the last couple of weeks. And the last week, things have started to turn south. And this is really where we see some potential downside here. The big number here is the 450 level here. If we break below 450, our downside target here is around 420 here to the downside. And if you look at valuations, CrowdStrike is incredibly expensive. It trades at 133 times forward earnings, which is, like, as you can see, it's orders of magnitude higher than its peers. It also, doesn't turn a profit. That's really kind of one of the big things that I think is concerning, is the fact that, as it grows revenue substantially, right? It does $40 billion in revenue in the last year. Trailing 12 months is $4.41 billion, $4.1 billion in revenue. They generate, a net loss of $172 million on that. So, trades at 28 times revenue, right? So it's not just expensive from an earnings perspective because it has low earnings. It's also trading at a very expensive valuation relative to revenue. And this is because obviously cybersecurity has been a big focus for a lot of Fortune 500 companies in the last few years. Almost every single week we seem to hear about a big hack. Last week we just had that big hack from Microsoft SharePoint. So no company seems to be spared from this, which is why companies like CrowdStrike that provide cloud-based cybersecurity services has been growing so substantially here. But you get to a point where the valuations just don't make any sense. I remember, during the peak of the pandemic, when you had all of those crazy stocks trading at crazy multiples, like even at the peak of that, we were trading at 22 times forward earnings. CrowdStrike's trading at 28 times forward earnings, 133 times earnings. These are just valuations that are incredibly hard to get your hands around. Especially if you look at growth expectations, it's not like it's growing at 40, 50% year over year. It's slowed down to like 20%, which there are lots of companies growing in that kind of range. Even Schwab is growing in that type of range, right? Robinhood growing at that type of range, but not trading at 133 times forward earnings, certainly not 28 times sales. And those companies are profitable. CrowdStrike's not profitable. So for those reasons, um, I'm looking at CrowdStrike and I'm seeing potentially some downside risks, especially given how strong the performance has been recently, and the trend has started to deteriorate here over the last couple of weeks. So we'll keep this on a tight leash, and we'll see kind of where that goes. Tesla earnings last week, stock moved substantially, a nice move lower here. It bounced a little bit back here on Friday. We'll see kind of how this continues, but overall, we continue to see lower lows and lower highs. It's really hard to bet against Tesla. The stock just doesn't want to go down, and investors kind of have a bit of a cult following with this particular stock. But the valuations, I stand by the thesis, the fact that trading at a valuation that's 15 times higher than its peers is just hard to get around, especially when you look at growth expectations have come down substantially here in the last couple of years. Net margins are strong relative to the industry, but nothing that justifies a stock trading at 167 times forward earnings. And not to mention, there's a lot of kind of value that's now embedded into Tesla being a robotics company, a robo taxi company, just overall, automation company. And the question, and those are all valid reasons for this stock to trade at a higher multiple. It has industry leading growth, industry leading net margins, and it's got a really interesting future outlook. Let's put it that way. So for those reasons, there's no. It's reasonable to justify a premium valuation for the stock. There's no doubt about that. The question is, how big of a premium should it justify? It's a hardware company trading at 12 times sales, 167 times earnings, which is just, like I said, orders of magnitude higher than what you typically would see with this type of business. So I maintain my bearish view here, especially when the business is slowing down, right? If this is a company that's continued to grow substantially, that's one thing. But growth has slowed down substantially in the last year. They've missed on deliveries, they've missed on earnings. And you can sell a really interesting upside, but from my perspective, that upside is just not there, given the valuation that's trading at the moment. All right, let's take a look at Walmart. So Walmart is sort of the antithesis of Target from the perspective of, if you look at growth expectations, these numbers look almost identical to Target. The only thing that Walmart's got Target beat is revenue growth. It's 4% instead of 1.5%. So, Is that enough to justify a valuation at 37 times forward earnings versus, one, the industry average is 19 and net margins are only two and three quarters. Target's net margins are 4%. Walmart's basically middle of the road in terms of its business. So Walmart trading at 37 times forward earnings, I really have trouble getting around that valuation, especially because uh, especially especially because Walmart has been trying to change their business in the last few years with regards to focusing on e-commerce. They've got Walmart Plus, which is a subscription-based, membership similar to kind of Costco or Amazon Prime. And those companies trade at high multiples, and that's part of why Walmart trades at 37 times forward earnings. But this is a valuation that Walmart hasn't traded at since the dot-com bubble. So I'm not saying that we're in a dot-com bubble or an AI-based bubble, but we're just at valuations that don't make sense for a grocery store. Or call it a grocery store, a fancy grocery store with a membership, but doesn't take away from the fact that it's a grocery store with razor thin margins. So for those reasons, I continue to take a bearish view here on Walmart. If you look at the chart here, the stock really hasn't moved anywhere in the last month since we've been bearish on it. So this is not a particularly this is not a trade that has been particularly favorable, but this is really one where when it reaches the top end of that range, looking at selling calls or call spreads are the type of way to potentially play this, where you're basically earning premium and having time on your side. Apple, this stock has continued to kind of stay below 215 here for multiple months here, underperforming the market by a pretty substantial margin. And we continue to view that Apple will likely to underperform going forward. Trading at 27 times forward earnings is just difficult to justify, especially when growth expectations have slowed down so much in the last 3 to 4 quarters, right? Apple's EPS growth used to be in the 12-13% range a year ago. Revenue growth was in the 8-9% range. We've seen that deteriorate substantially in the last year. This is due to kind of iPhone sales continuing to miss. Net margins is the one thing that so far has held up in the last year. But this is really where, is that enough to justify 27 times forward earnings when revenue and earnings continue to slip? This is really where I have trouble getting myself around that. And the chart seems to agree, right? The fact that as the S&P 500 continues to make higher highs, Apple's kind of continuing to bumble around its 52-week lows. It just really shows you how much Apple has lost in terms of momentum here. If it breaks out above 215, I would reconsider. But until then, I'm a seller of Apple. Now, like I said, this week is a big week for earnings. We have probably on any given day a couple of dozen, if not 3 dozen stocks that are reporting that are highly liquid. So our earnings navigator, we've got a lot of stocks in our earnings navigator this week. So for those of you that missed our session last Thursday or 2 Thursdays ago, this is really where we highlighted how we come up with our earnings navigator trades. These are stocks that are have a fundamental and technical alignment going into earnings. Basically, we look for stocks that are showing improving or strong relative strength that are undervalued to take bullish views on, or stocks that are overvalued that have underperformed underperformed the market to take a bearish view on. So we have Merck's coming up tomorrow morning. Merck's, Spotify, and Caesars coming out tomorrow morning. Merck's, we have a bullish view on. Spotify and Caesars, we have a bearish view on. Kraft Heinz on Wednesday morning, we have a bullish view on. VRT, which is pharmaceutical, we have a bearish view on. AbbVie Pharmaceutical, we have a bearish view on. First Solar, which is a stock that we don't hear about very much these days. Bullish view on, and Live Nation, a bearish view on. That's on Thursday. So a big week here on earnings. Quite a few that we have a strong opinion on, and those are the ones that I would look at buying, calls or puts on basically right before earnings, trying to take advantage of a big move as a binary event. And like I said, big week here on the economic calendar. You have GDP tomorrow. You got the FOMC meeting tomorrow afternoon. I'm sorry, Wednesday afternoon. You have the PCE index on Thursday, and you have non-farm payroll on Friday. So big week across the board on both economics, earnings, FOMC meeting, and you have the August 1st tariff deadline. So no shortage of headlines this week. So pay attention. Those are some of our trade ideas here for the week. Hope that you are finding this useful and giving you a better understanding of our views from a macro perspective and a deep dive into our views on the trade ideas for this market. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.